In 2022, headwinds weighed on lofty large-cap U.S. stock index valuations. Our chief equity strategist and economist, John Blank, is here now to talk more about that and give us an update on fair value. So, John, what were those major headwinds?
The Fed rate hikes, period, Terry. The Fed rate hikes.
And is that all still in play right now?
Yes, it is, through June.
Are stock traders not able to look over that headwind?
No, they shouldn't, because it's all playing out in the 10-year Treasury rate. And now that the Fed is more or less convinced the market that it's going to stick with the terminal rate at 5.25 for months, that's what's killing the stock market now, or holding it back in the headwind sense.
So then is the S&P 500 at fair value?
The 200-day moving average today on February the 23rd, when we speak, is 39.40 on the S&P 500. My latest calculation, with a 17 forward PE, which is the 5-year average for this market, is 41.20. So you can see right now we're trading pretty much just a little below fair value. So this market is pretty much properly valued.
So would you call this an index recovery going on here?
I would call this the middle of the range, between 3,600 and 4,500 is what I would say.
What role is the recession narrative playing in all of this?
The recession narrative is that 3,600, period. The 4,500 is the exit from the inflation and Fed cutting rates and following inflation down.
Bottom line, then, is the main market concern still the economy?
The economy is probably not the right word. The statutory mandate of the Fed to get 2% expected inflation is primarily the driver here. So it's the Fed mandate on inflation that's holding the stock market back.
Does the Ukraine situation put any pressure on stocks?
I would say, Terry, it used to, and I don't think it does anymore. That's what I would say.
2-year treasuries have hit levels not seen since November. According to the data, that has to be pressuring stocks, correct?
Correct. That's exactly what we were talking about earlier. The 2-year Treasury rate is the sum of 8 quarters of short-term rates that are quarterly. So it reflects the Federal Reserve, holding longer panache than anything else on the Treasury yield curve. So that's the example of what we can get from the Treasury yield curve that shows you the market's really believing the Fed's going to stick around for the next 2 years at higher levels.
As far as stocks you're watching, you have written in some commentary that the message from the late January 2023 Zacks industry ranks is consumer staple stocks firmly lead at a very attractive rating, and among them, Swatch Group AG. Next in line, the industrials and utilities come into play, and there you've chosen Reliance Steel and Aluminum Company and National Grid Transco.
Yeah, these are names we're looking at. Swatch Group, talking again February the 21st, is a number 2 rated stock. It's $17.40. This is obviously your Swiss play. A lot of people make money on Swiss stocks in Europe. It's pretty much the one place you can go to. So that actually is a worthy stock right now. Swatch Group, SWGAY. Reliance Steel and Aluminum, again, February the 21st or 3rd, and it's a number 1 rated stock. This is it's based in Los Angeles, but it's a leading metal service center in materials management and metal processing. So it distributes 100,000 metal products. So in that context, this is a great business right now, and it's $245 a share. It's not a cheap business, but looks good from a lot of perspectives. Forward PE is only 12. National Grid. This is basically a utility company for England and Wales, and plus supplies Britain's natural gas transportation system. They also, surprisingly, are one of the top 10 electric companies in the United States. So National Grid, NGG, is a number 1 rated stock again on February the 23rd. And if you're looking for some more defensive names, this is definitely one you want to pick up around $64 a share.
Our chief equity strategist and economist, John Blank, talking about fair value in the market with John. I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.